Clive McDonnell, who is the head of emerging market equity strategy at Standard Chartered Bank. Clive, many traders, investors wake up this morning and think, great figures from the US on jobs, we can therefore relax. But this week is a very big week for Europe and also for Asian economic figures. Can investors take some comfort from the US jobs or not?
I think investors will take some comfort from the jobs numbers. However, from our point of view, looking at the detail in the jobs report, I think there's a lot less to cheer than what meets the eye. But I think given that we've been through such a gut-wrenching period of negative sentiment in November, any modicum of positive news is seized by investors in the short term. But why we would quibble with the jobs report on Friday is that all is not as it seems. You know, the drop in the unemployment rate was primarily a function of a fall-off in the participation rate. So it's not so much that more people found jobs, rather fewer people declared themselves as looking for a job. And secondly, what will give us pause for thought is that if we look at the hourly increase in incomes, up about 1.8%, that's still way below what the level of inflation is in the US at the moment. So real income is still declining there, which from a more medium-term point of view will create, prevents that rebound in consumption that everybody's looking towards in my mind.
You talk about looking to next year, the word's gut-wrenching. You say Hong Kong has the greatest downside risk. We are structurally bullish towards India at the expense of China. Can you explain all that with the Chinese inflation figures out on Friday as the backdrop?
Yeah. Well, I think specifically on the China inflation numbers, as you highlighted at the outset, expectations, and we ourselves in Standard Chartered are looking for that number to come in below 5%, and I think the market will certainly welcome that. But we would focus more really on the monthly credit numbers, which will be out possibly on Friday, but more likely early next week. We see those as a much more important driver of the economy. Again, a bit like the jobs report in the US, people focus on the jobs number in terms of sentiment. Likewise in China, people focus on the inflation number in terms of sentiment. But from a more fundamental point of view, we would put a lot more attention on the monthly loans number, as I say. For December, we're looking for a number of about 580 billion, which overall is quite a respectable number. And I think that the achievement of that will go some way towards helping to lift some of the sentiment towards China. But as you correctly pointed out, we are more positive towards India relative to China at the moment, and that reflects some of the structural issues within the market. Bottom line is we don't think we're out of the woods yet with regard to the banks in China. And simply put, in India, while there is ongoing challenges for the government, there's not only structural impediments to growth in the economy, there's not only structural weaknesses in the banking sector, and that's one reason why we would trump for India over China at the moment.
Clive, I can't not mention Europe, of course. Mario Monti's €30 billion austerity and growth measures plan a day earlier than forecast. Angela Merkel saying absolutely no to the idea of a euro area bond. And clearly also this week a big week for EU. ECB meets to discuss rates. And of course EU summit on Friday. All this happening again. What is the exposure, or rather how great is the exposure of China, India, Hong Kong, for example, to this European crisis?
Oh, I mean, bottom line is that China is most exposed. 27% of China exports goes towards the broader European area, and hence the risk of a recession in the Eurozone, UK, Switzerland will certainly act as a big drag, hence why a lot of focus in terms of trying to stimulate domestic demand. Hong Kong does, of course, have exposure towards Europe, mainly via China, second biggest container port in the world as well. But the concerns about Hong Kong really relate more to the property sector than anything else. But homing in on the European summits this week, ECB meeting, Standard Chartered looks for 25 basis points cut to come from the ECB. But I think the crux of the issue heading into the European summit will be the whole issue of treaty change. And the conclusion is that if we see the Germans push for a wholesale treaty change, we'd see that as negative short term, but positive longer term for equity markets. Conversely, France, Nicolas Sarkozy, he would be much more in favour of micro change in the treaty in the short term, possibly a core group of euro markets going forward. I think that will be viewed positively by the equity markets in the short term, but we see that as negative in the longer term.
Clive McDonnell, many thanks for joining me. Clive McDonnell there, the Standard Chartered head of EM Equity Strategy.